Greetings everyone, Joseph James with your nightly newsletter brought to you by theschooloftrade.com. Today was September 1st, 2009. First week of September, which means all we got to do now, guys, is get past Labor Day at the end of this week. And next week, middle of next week, we will start seeing that transition from the slow, choppy summertime trading into the more aggressive, higher volume fall trading environment. So make sure you're with us next week. We'll be watching as that transition unfolds after we get back from Labor Day holiday on Tuesday. I want to remind you guys we have a free resource online. Head to our YouTube page. Check out YouTube.com/School of Trade. And while you're there, guys, subscribe to our page and please rate and comment those videos. Today we took two trades. One was a scratch, one was a winner. Little one target winner there on the first trade of the day. Put 60 bucks in our pocket, didn't see anything else. We took two trades today in the entire morning. Another one of those slow days here. And this week's going to be pretty slow, guys. It's going to be a week where we have lots of people going on vacation. It's the unofficial end of the summertime is this week. So a lot of people are going to be away from their desks, enjoying their time with family and friends. So we expect to see this slow, sluggish market continue here the rest of this week. Two trades today. We'll take what we can get, obviously. 60 bucks total. That brings our monthly total to 60 as well. Our term of the day today is continuous contract. Now, you may be familiar with what a continuous contract is, but you may be unfamiliar with how we use it, why we use it, and kind of the specifics regarding the futures contracts and how they expire. Continuous contract, what is this? A futures contract, they don't last very long, right? They expire quarterly, every 3 months. Now, how do we test a long-term trading idea, or how do we look back anything more than a few months in price action if all these futures contracts last is 3 months long, right? How do we see anything more than 3 months back? Well, the simple answer is you string them all together. Put all the contracts together, and that will create a continuous series. You've got your March contract, you've got your June contract, you have your September contract, and you have your December contract. Right now, of course, those are the four contracts that happen all year round. Now, some markets like crude and gold, they may use different expiration months. But for the most part, most futures contracts only last about 3 months. So how do we get a long-term look at the market? Well, you got to string them all together if you want to have a long-term look at the market. That creates what we call a continuous series. Now, it's not as easy as it sounds, and prices are always different from one contract to the next. So if you're comparing the crude oil, looking at the front month contract, which right now is, October. If you compare that to December, the current price will be sometimes quite different. So it's not as easy as it sounds to just simply stick them all from one end to the next beginning, to the next end, to the next beginning. It's not as easy as just putting them all together. So how exactly do we calculate, or how do we provide you with a continuous contract? Well, first of all, there are lots of different ways to do this. The first way is called a Splice Chart. This, again, is the simplest way. It's where we literally put all the different contract months together. The problem is that this is sloppy and it has large gaps because prices are not going to be trading the same price when one expires and the other starts. It has these large gaps and it looks very sloppy. Now, there's a term called a Panama Chart, and of course these terms may be a little bit unfamiliar with you guys, but I want to give you guys some examples of how we can do this. A Panama Chart is when individual deliveries float up or down so they join smoothly to their adjacent deliveries. Now, what does that mean? Individual deliveries float up or down so they join smoothly to their adjacent deliveries. Now, what that means is that there's a premium attached to every single price. A current front month will have a lower premium, right? It's going to cost you less to trade on a current front month than a future front month. So what happens is they actually, and these are some kind of technical terms here regarding the futures industries here, but a Panama chart ultimately takes the current price of the expiration chart, right, the expiring contract, adds in that premium. Now, if you want more information about premium, come out into the trade room and ask me the question. I'll tell you guys all about premium. Now, of course, that premium added on helps to bridge the gap that we would see with a Splice chart. So a Panama chart, even though it's kind of technical, it can be the better solution to the problem. Now you have a cash chart. A cash chart shows the actual spot value of the underlying instrument, and that is a way that we can kind of bridge those two gaps. You've also got an LME, which is a London Metal Exchange chart. This shows the price of the future as at a set distance from the spot. So again, the Panama, the cash, and the LME chart are all going to use different techniques to create a better looking Splice chart. So what's the easiest way to do this? The easiest way to do this is to use the simple Splice method. When one contract ends, the next contract begins, even if there are gaps. Now, some pros of this, right, some good things is it's easy to do. There are no calculations needed. But some cons to this way of doing it is there are large gaps in price. It can be tough to trust those levels around those gaps, as you can imagine. And it's tough for any automation to understand those gaps or to backtest. So if you're using automation or if you're simply looking to trade around those areas, the best way to do it is to contact your charting package. And your charting package should have a very seamless and what you would call a continuous contract that you can use. Now, we use NinjaTrader, and NinjaTrader actually right now, as of September 1st, 2009, they're about to release their 7.0 version, and that's supposed to have continuous contracts in it. So we're actually looking forward to seeing that on our own charts. But pretty much every charting package has their own continuous charting examples. And of course, we look for what they call the sharp symbol, right, the pound sign, to identify a continuous contract. So the S&P would be pound or sharp ES. Then you've got pound 6E. In other words, there's no front month symbol used, just that pound sign. All right, guys, that's a good example of continuous contracts, how we use them, why we'd use them, and of course, come out tomorrow morning and we'll show you guys how we use the front month contract in our live trade room. Now, the beginner's course is highly recommended for all free trial members. Our room opens up at 2:45 a.m. Eastern Standard Time, so make sure you guys come out and join us. And we'll show you guys all 3 jobs, that is identify, adjust, and execute live in real time. Now, trial members, make sure you pick up a copy of the beginner's course when you come out. Lifetime members, make sure to bring your worksheets with you. We'll trade the European session at 3 a.m. and the U.S. pre-market at 8, as well as the U.S. Open at 9:30, closing around 9:30, around 12 o'clock Eastern Time, noontime. Let's take a look at some of the trades we took today. Now, the first trade we took today here in the room, 11:14. I'll zoom in on this for you guys. This on the crude, a 2-step long here at 69.90. Now, we took profit here at 3 ticks. We took 2 off at 3, totaling 6 ticks at $10 a tick. That's $60. Now, of course, as you can see, we had to wait almost the entire morning to take this first trade. 11:14, we were expecting to see some trades a little bit early this morning, but we had to use patience and discipline to wait for the best setups to come. We saw this one happen. It fit all of our rules, plenty of room ahead, everything lined up. We took the trade. And like we see a lot of times with these 2 steps here in the August month or the summertime trading, is that we see this kind of lackluster follow through. And that's exactly what happened here. If it wasn't for the way in which we manage our trades, we probably would have taken a loss on this. But of course, we manage our trades very conservatively, got out of this one a little bit early, and of course, saved that profit, stuck it in our back pocket, and saved it here for the rainy day. Our next trade of the day was a scratch trade. About a half an hour later, 11:43 here in the S&P, this is a 2-step long at 1,004.5. Now, this is a scratch trade, and ultimately the reason why it was a scratch trade was because we have what we call a 3-strike rule when it comes to our trading. A 3-strike rule means that if I don't see my first profit target filled within 3 attempts, I will then force the profit target filled, right, moving the target down or up, wherever it needs to go, and then move my stop to my point of entry. So once we saw the 3-strike rule in effect here, I had to follow my rules. My rules tell me exactly what to do when something goes wrong. And in this case, we moved our stop up to our point of entry, eliminated all that risk, protected our position, and then if the market wanted to go in our direction, we waited for it. Well, it didn't. And as you can see, it came crashing right back down against us. And this particular trade itself would have cost us 24 ticks if we wouldn't have followed that very simple 3 strikes rule. Guys, we're going to give you all the rules that we use in our trading live in real time, so come out and join us in our live trade room. What I want you to see at the bottom of this, guys, is an example of our pace of the tape indicator. Now, you'll look at the bottom here, you'll see we've got different colors, green, yellow, and red. One of the rules we use to enter these trades is we must see green pace of the tape bars, or what we call pot bars. This pace of the tape, you could think of it as being the speedometer for price action. So we waited patiently to make sure that we had only green pot bars to get into this trade. We saw them, so of course, that confirmed this trade to the upside. The pace of the tape indicator, obviously being one of the proprietary indicators we offer to all of our lifetime members, we're going to show you guys how we use that every day in our live trade room. So come out and join us at 2:45 a.m. Now, Mondays and this whole week, we open up at 7:30 a.m. due to the holiday. We do free webinars on Tuesdays and Thursdays at 11:30 a.m. Eastern Time, so come out and join us for those. Same place. We'll trade any market, give you live calls. We'll show you guys how we enter, how we exit, how we manage. Plenty of opportunities for questions, guys. We'll give you a free 3 weeks as part of our trial. And remember, the beginner's course is highly recommended for all free trial members. Drop us an email for more information about lifetime membership at sales@schooloftrade.com. My name is Joseph James. I want to thank you guys for your time today. We'll see you guys back in the room tomorrow morning. Remember, holiday hours this week. We open up at 7:30. We'll see you then.